So I'm part of the SBDC. I'm the regional director for the Lubbock Center. You'll see all the whole yellow spot is the Northwest Texas Center. It's all hosted by Texas Tech. We have centers all throughout West Texas that you can reach out to, right? So even if you have a friend or a neighbor who lives in Midland or whatever, we could probably help them too. We have a center there as well. We're part of a network of almost 1,000 SBDCs throughout the country, and our goal is to be a support center for small businesses. Most of our clients are 5 people or less. They're the definition of a small business. And so what happens is they're very good at maybe what their passion is, but maybe they don't have quite as much familiarity with some of the other business aspects of things. So we'll help them fill in those gaps a little bit, right? So one of the main things we do or can provide is zero cost. That's nice because you already paid for it by federal dollars, state dollars, economic development dollars. You can have one-on-one consulting with your business or with you as you're thinking about a business. You don't even have to be a business. You could just be considering that, and you want to kind of know a little bit more. And so what we provide is that one-on-one consulting. There's not a limit, so it's not like one time and then the first one's free and you got to pay after that. Doesn't work that way. You're already paid for it right through your tax dollars. And so what we try to do is just help you maybe understand some things that you have not ever heard about or you just need more information about, okay? So we do the one-on-one consulting, but in addition, we do tons of market research for the customers when they want to know a little bit more about their financial benchmarks. In this case, that'd probably be the case in this class. And the last one I taught was about market data and about demographics connected to your target customer, that kind of stuff. We can give you all sorts of data that we are tied into. People pay thousands of dollars for right now, every day, to have that kind of data, and we can get it for you for free because we're part of the SBD Center. And so I'd love for you guys to think about that. I absolutely love the financial benchmark sections of some of the databases because I may not know very much about being a frozen yogurt stand, right? But I don't. And so what do? I can at least understand that there's been 700 other people in that industry, and here's where they spend. Here's how much money they spend on a facility. Here's how much they spend on on payroll. Here's how much they spend on these other items. And so we can compare your situation to theirs, right? And it helps me know how to help you. Okay. In addition, we have the classes like these. We put on classes and workshops. Some of them are webinars. You just kind of tune in for the hour while you're at lunch. Some are in-person classes. I did a class over this last weekend. It was all about business plans, right? And here doing this one, and we could spend. Actually, it's shameless plug. We have a USDA grant for a Profit Soup course. It's a 6-session course on Tuesday nights. That it is all it does is look at financials. So if you are interested in that, use my business card, send me a message. It's free to the public, but we can't keep the registration open because we want to make sure the licenses are being used by people who are committed and interested. But those 6 sessions take you through every financial statement we're going to fly through today in minutes. And it'll help you understand your break-even analysis. It'll help you understand your fixed costs versus your variable cost, your cost of goods sold, the whole thing, right? So if that is something of interest, you do not forget to send me that. It's not on this list because it's kind of like by invitation of sorts, right? But also on the list, QuickBooks for Beginners. They're providing that course. It is one of the few there is a charge because we have to bring in a QuickBooks certified instructor. And so, but it is very popular. People are always needing it. And so if you want to just understand how to get your QuickBooks a little more straight, okay, then that's a great class for you to take. It's going to happen on Tuesday evening as well. Yeah, Marco?
What's the name of that unlisted course?
It's Profit Soup, okay? And if you'll send that to me, I'll send you a link for the Profit Soup registration. You'll probably see it if you go to this QR code. It'll probably show up on the list, but you can't register because we kind of have to monitor that. But then what you just say, hey, that's the class I want to be part of. And it's 3 sessions. I'm doing it in 3 phases. So some people are comfortable with only doing the first phase for now because they're just not ready for some of the other. If you want to do 1 phase, that's great. Maybe that's too beginner. You kind of been through it a little bit and you want to do the 2nd phase or the 3rd phase, totally okay with me. I mean, it's being paid for. So absolutely use the service, okay? And yeah.
How much would that cost to do that QuickBooks?
I think it's $99. Yep, $99. All right. So we provide those different things. And so please, these and others. And so please take advantage of those resources. They can really help a business, like I said, fill in the gaps. All right. So as far as financials go, like I said, I can tell you a lot of information today. What I'm going to try to do is there's a couple of key things I want to make sure everybody knows. Now I know I got an ex-banker and a bookkeeper in the room, so he's probably, I'm not going to let him answer questions because he's probably going to spoil my plans here a little bit. But in basic bookkeeping, if you have a list, you have a list of glossary of terms, right? You'll see that in one of your handouts. And I want you to understand that if you don't know what those things are, don't feel alone. There's people who've been in business for years successfully that may not know some of the things on that list. But it is important for you to know what every one of those things are, okay? And so if we don't talk about it today and we did, but you need some more time, this is where I want you to reach out, set up either get in another class or set up a session and just understand. I really, personally, I've been in private business for like 18 years before I became the director of the center. And for me, it's so interesting how many people are doing it and working hard and killing it, but they're not quite sure about their own numbers. They don't really know where the dollars are coming from, and they don't know how to even make good decisions about the information because you can't manage what you don't know, right? And so I really like to look at it. I know that some people like, numbers, really? Financial statements, really? No, really. It'll tell you things that you may be surprised by, okay? So basic, I'm going to start out with, there's a cash-based accounting system and an accrual-based accounting system, right? I'm going to share that I was surprised. One of the things as I started meeting clients was how many of them are just running out of their checkbook, right? And it's cash-based. I got money. I made money this month because I got $100 left or I got $1,000 left. Next month, maybe I don't. And so this is the way they're thinking, right? That's really not even cash-based accounting, frankly, but it's a lot more common than I expected. All right, I'm going to share, I would suggest you figure out or learn how to do the books needed for an accrual-based system. That is the only real way you can measure one period against another. If it's real small scale and you don't carry AR and you buy things and sell it in the same day or so, maybe that cash base can work for you for a while, but at some point you should outgrow it, in my opinion, all right? And so accrual base, what's the difference? So cash, you kind of know. Cash in, cash out. If I got money coming in, somebody wrote me a check, it goes in the bank, revenue. If I spent money on utilities, out, that's an expense, right? What's the accrual base? What's the difference between those two? Anybody ever heard of the accrual base system? Okay. All right, you want to throw an answer, the definition? Okay, all right, all right. So what's happening with accrual, okay, is when you book the business or sign the contract or whatever, you book the revenue when it happens, all right? It's likewise, when the bill comes in, all right, you book the expense, even if you may not pay it for 30 days or 60 days. So when you pay the bill for the supply, that's not an expense in 2 months from now. The expense was booked when it happened. And so you really do want to think, what happened this month? Right? And that is, as you'll maybe see in some of the examples we give here in a little bit, why it's very critical to understand. There is a big difference between profit and cash, okay? All right? So, overall accounting in general, whether you're doing cash or accrual, doesn't matter. This is the basic accounting formula. Y'all ever seen this formula before? Okay, most people are pretty familiar with it. You get assets minus liabilities equal equity, okay? Right here on the bottom, it just says, if you take what you owe out of what you have in assets, it'll tell you what you're worth, right? The trick to this is we're not going to be able to figure out how to be accountants today, but accountants take, whenever there's a change or a transaction in one area, they go and make a balancing transaction in another combination of accounts, right? So if someone's buying an asset, then the cash has a reduction and the asset line has an increase, okay? It has to balance all the time because that's the only way it's ever going to tell you the information you need, okay? So if someone is going to put money into a business and they're starting out, they're going to put cash into a bank account. Now they got $10,000 in the bank account, that's an asset, and now what did it go to? You didn't owe any money for that, you didn't, or anything, but it's over there for you to run your operations. It becomes part of the equity portion. Now the specifics, I'm not worried about necessarily. I just wanted you to mentally understand kind of what's happened with the flow. The information has to go from one place to another, and it has to balance, okay? And the double entry method been around for, gosh, I wish I should have looked it up and seen. It's like way back in ancient Greece, okay? It's been forever, right? Here are your 3 statements, okay? This is what I want you to leave today. Sound important. Go tell your significant other tonight that you know all you need to know about about balance sheets and income statements today, and just tell them, because you know these are critical for you to understand what's going on in your business. People are pretty familiar with the first, the income statement, profit and loss, right? That's how much money am I making, right? Banks, they love to look at they look at all things, but they you know, often the one thing you give people is a profit and loss, okay? Here's how much money I made, here's all my expenses, here's what my net is, okay? Sounds simple, but it's probably a little more complicated than you think, okay? Balance sheets, people kind of familiar with the balance sheet? Okay, kind of anybody know, kind of want to take a stab at what the difference between the information on a balance sheet is from the information in an income statement? Yep, I'll let Marco, since he's the,
Balance sheet is what you have right now at a point in time. But it's that equation that you put up the assets and liabilities.
Absolutely, spoken like a professional, because he is. So here is, the balance sheet is a snapshot, at that moment in time, what you have. It will tell you on September 12th, if you did a balance sheet, this is what I have. This is what I have my cash balances. This is what I have remaining notes on my loans. Here's what I have my equity, everything, right? Income statements are over a period of time. This is how much money I made over the 3rd quarter. This is how much I made over last year. And it's general information about how the profits of the company, but they are not, the same things are not on both reports, all right? They all sync up number-wise, so you kind of need to know that. But there are different things you learn from each statement. So balance sheet and income statement, I'm going to tell you, if you can learn that, you're 2/3 of the way there, right? You only got one more statement to go. But I'm going to share with you that the cash flow statement is the most important, and people don't give it enough love, right? Because if you don't have cash, you can't do anything. Right? You run out of money, and it could be all kinds of reasons. So I want to ask the question, and I'm going to get some participation here. How many people think you can be profitable, making good money, making good margins on your goods or services, and go under? Okay? Why do you think that's the case? Surprise. Something comes up out of the blue. You're making good money. You got good customers. Everything's looking good. You can still get hit with a big surprise. Anybody else can think of something? All right. I'm going to say yes. Okay. Cash is not the same as profit. Okay. People, they'll look at their checkbooks and say, well, why doesn't my accountant say I made 12 grand? I have $1,000. Well, because the accountant is having to use different methods to figure out what your profit is, and that's not the same as what your cash balance is, okay? And so I want you to learn before you leave today, to sound important to your friend or neighbor, why the cash flow statement is important. Now, once again, we could give very specific examples, but I just want you to understand this is real common categories within a asset. I want to ask, anybody want to volunteer? What kind of assets can a company own? You got an idea?
I would say, you said assets?
Assets, yes.
I mean, well, you listed one of them up there, accounts receivable.
Accounts receivable, okay, accounts receivable. What is accounts receivable? People owe you, absolutely right. Another asset, what's another asset? Equipment, absolutely. Inventory, absolutely. Those are big assets. You spend money on inventory, cash reduces, inventory goes up. Doesn't change anything over here, maybe, right? Or maybe you get a loan for that inventory. There's all kinds of reasons you got to think about where the money is going, right? But these are some basic categories. Inventory, cash, those are up here. Equipment, land, everyone kind of gets that, right? Hard assets make the banks happy, right? Things they can turn around and sell if you decided to close up shop, all right? But there are other kinds of assets. You can have a patent. You know, you can have trademarks. There could be some goodwill that you've got from another business you've owned or something. So there could be other types of assets on the list, but those are the most common. Everyone knows bills, right? Liabilities, that's what you owe. Ugh, okay? We all owe bills, all right? But notice there's 2 sections here, the current liabilities and the long-term liabilities. So what's a current liability? Or even a current asset, notice, there's current assets too. What does that mean, current? What do you think they're trying to tell you on a report if you see the word current on it? Okay, month to month, that's a good guess, absolutely. All right.
Less than 1 year type stuff.
Well, but it is a little bit longer, that's 1 year, right? So that's it, but it is things that you expect to either use, assets you expect to use, or deals you expect to pay in a year under normal operations, okay? So if you have, bills for the electric bill or supplies or something, those are bills that come in. Maybe they give you 30 days, maybe they give you 90 days or whatever, but it's still a liability that you expect to pay pretty soon, okay? The asset, okay, cash, or in this case, maybe inventory, you don't want to keep your inventory too long. Maybe for the summer, maybe for a particular season, you expect it to go away too. But the building that you're in, you don't want it to blow away, right? You need it here. It's a long-term asset. Okay, so the reason I put this example up here with the slide is while we understand current and we understand long-term, what's going on, why does this matter? Okay, well, the banks are going to look at these and decide, well, how liquid are you, right? They'll do quick ratios, acid ratio kind of stuff, and they'll think, well, okay, take the current assets and you take about the current liabilities. What kind of liquidity do they have? What does it look like in the next year? Because in that one little question, you can see, okay, what does this look like? We've got inventory there's 17,000 in current assets, and we have current liabilities of 7,000. And that's an attractive ratio for the bank. 7,000 in debts, and you got 17,000 in current assets. Yeah, that's not bad. Now, every industry is a little different. It may be 1.5, might be anything above 1, might be 2. They may have different, banks may want to think about it differently, but that's, if it was the other way around, that could tell somebody a problem, right? Oh man, I've got a lot of debt, but I don't have a ton of inventory still left. Maybe some of the inventory was bad and you had to just kind of take it at, pennies on the dollar, and your cash didn't go up as much as it should have based on the inventory. And so now that would tell anybody looking at your balance sheet, you've got something else kind of happening within the year. Now this is still, once again, a snapshot in one day. There's a snapshot in time, but it can tell you a little bit about what might be happening over the next year. All right. Now there's another aspect on here. It's a common problem that I see in, I don't know if I want to quite say 95%, but pretty darn close of clients who actually have worked on their balance sheet, worked on their financials, and they're not too bad, right? But they seldom ever break out the debt piece into long-term and short-term. So if you have the property above the building, right? Okay, that building you're going to be paying on it for 30 years or however long, right? And so in your balance sheet, you should separate the expense for the next year. Here's the interest on that loan, not the payment. If they even do separate it, they usually separate the payment, and that's still not technically correct. Here's the interest I'm going to pay on that loan for the next 12 months, and here's the other 19 months afterwards. And they'll separate it because it really should be figured in to your obligations for the next year. And sometimes it's not, right? So that's one very common problem. I just want you to understand. So in this long-term loan, the current portion, $5,000, is going to be the part you are going to pay in the next year. Once again, it's not the payment, because the payment needs to be split up into interest and principal. But what if it's a lease payment? You rented a truck, the truck's for 5 years, okay, it's $1,000 a month. Okay, what should you see on your current liabilities on your balance sheet? You should have 12 payments, $12,000 on a lease payment, is an obligation that you should show, because the rest of it is a long-term. Now, leases can be a little different. I'm just kind of using it as an example. They're not really your asset until you're finished paying for it. But there could be, I just want to use it as an example of kind of why those things matter and what you need to be thinking about with some of the expenses that you've got. So the profit, we mentioned the profit and loss is the period of time. This little formula right here, I want you to understand the best you can. It is amazing. I got an example, and I use this example because I love it for certain reasons, but it's not a great example of a balance sheet, of an income statement. And I was going to ask you why it wasn't, but we got too much to do to probably cover that. But here's the thing about profit loss statements. Often what people have, they know what money came in, right? That part of the equation is usually pretty good. They understand the top portion of the revenue side. They've got 2 or 3 different products. They have services. They made deposits. Maybe they get that down. But when I ask them, well, what's your cost of goods sold? And they not sure. They get lost. So what is the cost of goods sold? You look like you're ready to answer. Oh, no, okay, all right. You look like you're ready to answer. What's the cost of goods sold? Okay, all right.
Purchase and shipping costs.
Everybody has cost of goods sold, or cost of services sold, right? It's tricky sometimes to figure what it is, but basically it's the supplies or materials. You have a fence company. You get paid to put fences up, okay? So what are you going to buy? You got to buy the lumber, you got to buy the tools maybe, you got to buy the nails, you got to buy, whatever else, paint, stain, whatever. All of that goes into the cost of you to earn the dollar. So what's happening when somebody asks you, what is your cost of goods sold or what's your gross margin? They're asking, how much does it cost you to make a dollar? Okay? That's what they're asking. So a gross profit, I don't particularly like that term, but it's used interchangeably with gross margin. Because gross profit makes it sound like you've made profit, but really you haven't because you still got a lot to pay. But, yeah, got a question?
So I have like a children's museum. So I would include paper towels, cleaning those as goods sold because I have to keep it clean for people to come in.
Technically, no.
No.
Okay, that's why it's a little tricky, all right?
Okay.
All right, so that's okay. So let me kind of see if I use your example. So this is specifically an expense connected to the dollar that you're bringing in. So maybe the material, or maybe in your case, money you spend on the displays, money that you pay a vendor that goes to the items that are in the, maybe that kind of stuff. For them to show up and pay you $10 to come to your museum, I have to have these things for them to see, okay? Now there's other expenses in a minute we'll break down. The selling, administrative, and operating expenses is where those things are, yeah, okay? Because those can change and those can vary, but no matter what, to earn that, somebody is gonna pay you $10 for a hamburger, you gotta give them the hamburger. So what's the hamburger? You might change other things about where they're getting the burger, and you might change stuff you put on the wall and all that, but you're not gonna change the burger itself. Now, that's what the cost of goods sold. And it's tricky because it's got some nuance. There's not an absolute sure, no doubt about it, way to figure out your cost of goods sold. It is up to you to understand that, not your accountant, because they're going to do their best, but they may not know your business that well. It's up to you to understand those numbers because you're the ones that are going to be managing the business. You need to figure out, are you spending too much on supplies? Are you spending too much on shipping? I have to spend X amount of dollars. I have to spend 47 cents to make a dollar. Okay? Critically important question that most businesses struggle to answer. You are not alone, but really to get a handle on how to make good decisions, you need to understand that gross margin percentage. Okay? Now, that's not all the bills, right? That's just to give the person a burger. That isn't all the expenses. So let's say the fence person. We talked about nails, stain, whatever, right? What other expenses does that business have to incur and deal with to make sure that service has been provided? You got some examples? Got some?
The workers.
Workers, absolutely. Payroll, completely, absolutely. And so that's very important to know because, that can vary and you can figure out creative ways to maybe whatever and pay them and maybe they do percentages, commissions, whatever. It doesn't matter. All that still is an item that that has to be factored in, but it's not part of your cost of goods sold. Okay, it's separate. Now, I had a client and I agreed with him. He had a machine that if there wasn't a person working on it, it was worthless. So he had to have that person. For every hour that person was paid, that was the only way the machine had any value. It was going to make him no money unless that person used that machine. So he decided to put the hour worth of payroll for that individual into his cost of goods sold. It helped him understand exactly how much he spent. It was his own managerial decision, and it's totally okay. In fact, the books that you have, you got a bookkeeper in here, the book that you keep doesn't have to necessarily be the same set of books that the accountant keeps. They need to match. They just sync up, but that person has got a different role. They're trying to keep you from paying taxes. So how and way they look at the numbers is different than the way you look at numbers. And you may need more detail, you may need more something, okay? In maybe your POS system breaks down all kinds of ways you bring in money. That accountant doesn't care, the revenue is what the revenue is. So it's not up to that person, even if you're paying big money, that you are the one that wants to know that, right? So you can be successful. In your case, okay, in this particular case, Well, I mentioned the guy with he did not include the payroll for the managers or for the office people or the support staff, because that was all separate. That was overhead. And so you can make, you can separate things is what I'm wanting to help you understand. All right. Now, you with a gross margin number. I can tell you by pulling up a report over the frozen yogurt place or a car dealership or something, what is the normal cost of goods sold that they see? And that's where I want you to come in and talk to me, and we can do a report. I love to give everybody the whole report. I mean, some people like to scale it back, but if you want 40 pages about your industry, I can give it to you. And then you can really understand where people spend money doing the thing you do, right? Some of those, if it's the right industry, you'll have 1,000+ people. So you really do get where, what to expect. It's nice because if people haven't opened a business, they can understand how expensive it actually is to open a convenience store or whatever, right? And how much inventory does those people usually carry? Or how much AR do they usually have? And how long do they got to carry the AR? All kinds of questions could be answered with the financial benchmark research we can provide you, okay? Now, after you get to your gross margin dollar, you got to pay all those other bills. Pay your employees, you got to pay the rent, you got to pay the utilities, maybe some advertising, whatever else. You got to buy the cleaning materials and paint for the building and whatever maintenance and other stuff you've got. That comes out of that gross margin total, and then you're left with what's, at the end of the day, your net profit. Okay? So, what do you think the normal net profit is for a business? I mean, it varies a bunch. I'm not needing to, I want you to think there's an exact answer. Do you think business ought to come up with 20%? Right? Think that's pretty reasonable? You don't think so? What do you think? The 20%? 10%?
I think 10%.
Okay. So 10%? All right. All right. Well, it can vary. I don't mean to be, putting a generalization out here, but I mean, there are businesses that would do dances every day of the week if they could consistently make 5%. Supermarkets, tough industry with low margins. And so 1 or 2%, very common, 1 or 2%. Yeah, okay. So I mentioned the frozen yogurts because it came to mind. I did some for a class once, and so I said, well, pick a couple industries. And they were flabbergasted that the frozen yogurt place had a 12 to 15% net margin, and the fancy auto brand name car dealership had a more of 5%. All right. Yeah, so you're thinking, well, where do you make more money at it? Well, I mean, scale makes a difference because a big car dealership in the right economic situation can sell tons more cars than you can through a yogurt shop, but the profit is still there, okay? Now, what does that mean, net profit? That's, you take a dollar bill and you break it up into a bunch of nickels and dimes and quarters and pennies. That means for every dollar you brought in, by the time you threw spreading it all about, if you could end up with a nickel, you're doing okay. Now, you might be able to figure out a way to get 8 cents. Or if you're in a right situation, maybe this, strike gold or something, you can get to 15 cents. Or those businesses that have high profits, there's usually a high risk, high reward type of thing. It's the thing, it's great for a while, but it, like oil or whatever, you can crater. You just never know. So that is what your net profit is. Okay, that's what's left after everything. So your hope is to have at least some. Some people struggle to keep it at zero. And they got to figure out what's happening. Where are they wasting some dollars? Where are they wasting some money? Is there something I can do about it? It gives you some way to decide. Like I said, you can't manage what you're not aware of. And so this is what you're trying to do with that information. Now, I mentioned cost of goods sold because it's so tricky and so many people struggle with it. So let's give us an example here. I'm going to make somebody answer. I don't know who. I don't know. I'm not going to let Marco answer. But okay, so you have a business, okay? And you sold the food, and so your food is purchased. Your revenue in January is $45,000. The food purchased in January is $15,000. Okay, is this correct? Cost of goods sold, $15,000. Okay, is that what the cost of the goods you had? Does that seem? There's anything about it we're not thinking about? Nope. So your gross profit would be $30,000. All right. So that basically means your margin is what's left. Okay, so I want you to look at this example. This is the one I'm going to make you answer, actually. Okay, your sales are $40,000. You purchase an inventory $100,000. Yikes, inventory. bought up a bunch of inventory. What is your cost of goods sold? You want to give me you want to give it a shot? Is it 60,000? Is it 100,000? Your cost of goods sold is 100,000? Shaking your head no. Why is it not 100,000? Okay. All right. Here's the hard part. Okay, it's the cost of goods sold, not the cost of your inventory. So we have no idea how to answer this question because we just bought inventory. This is a cash flow question, not a cost of goods question, right? So I'm being a little sneaky because you can't answer this question. But the whole thing is, just because you spent it out the door and wrote a check and have now a bunch of inventory in the back doesn't tell you anything about how successful your business is, right? All right. So what do you need to know? What do you need to use? Well, you need to think, well, what was my inventory at the beginning of the period, at the end of the period, and it's like a mathematical calculation. So in this case, if we knew that our inventory was 35, we purchased 100, at the end of the month we had 113, that means we used $22,000 worth of inventory in that month, okay? In the month that we sold $40,000. So see, now somebody who has their books kind of straight will realize, well, I made a gross profit of $18,000. That's a lot better than minus 60,000, right? You don't even understand what's going on with the minus 60,000 number. It's too complicated. And so people using checking account kind of bookkeeping will struggle. They won't really understand where I'm making money. Did I make money? Now your question might be, did I make enough money? Was my margin better this month than it was last month? Was there something else that happened that changed that? But that is why you want to really understand your cost of goods sold. Inventory does complicate it, no doubt. Okay? Now, I want you to pull out your income statement. I'm going to ask you to invest, okay? Or potentially, okay? I'm doing my Shark Tank impression, okay? All right? I'm coming out here and I want you guys to invest. Take income statement. See the income statement? This is a real, I use this because I love this example. It was my counterpart Ray in my office. It's an actual client of his. Of course, we changed the names and done a few little differences, but it's fundamentally exactly the same as what this client had. Okay? So I want us to talk about a couple things about this particular spreadsheet. This particular financial statement. Notice, what is his gross margin? It's exactly the same as his revenue. Is that helpful to him? No. I would first tell him, let's figure out what your costs are for the money that you're making so we can create. What he did is he's probably got down here on the bottom, he's got some of those expenses all kind of baked in. Doesn't mean that his net's wrong or anything. It just means that he doesn't understand where his expenses are being spent necessarily, right? And so he doesn't have good information. So this is an example where I would give him some suggestions on how to improve the information he's got at his hand. But let's just assume that's not a problem, right? I want you to invest. This guy, look at this, first month. Now notice this is like August. I cut out some dates just so it would fit on one page. And then so we're going from August to July. This is 20. I meant to put 26, not 2006. Anyway, all right. So here's what's happening. And these really happened. Everything in this financial statement is 100% accurate. So I'm not trying to play a trick like I did with the slide. I want to ask you. This guy says, hey, I'm going to do these contracts. I've got these contracts, and I'm going to make good money. First month, the guy has net earnings before tax of $18,000. That's pretty good, right? He only had $135,000 in revenue, and he made $18,000. Not bad. So then the next month, did the same thing, did that for a few months, 18, 16, 17. That looks pretty good, right? Okay? I think so. It looks pretty good. So the second little phase, half of the thing, he decided, man, that's going so good, I'm going to open a whole other branch. All right? And I'm going to do these other contracts in this other location because, man, this is like great. This is like money falling out of the sky, right? So he does that, and then he jumps up, and look at this, $48,000. Now he has made in this first year $378,000 net profit. That looks impressive, right? So I'm that guy. Invest in me. You think this is good? If I had your money, I would even do more great things. Can I get you as an investor? You gonna invest in my company? Sure. Okay. You gonna invest in my company? You gonna invest in my company? All right. Looks good, right? Okay. Absolutely. Okay. I understand why you said that. That's a completely reasonable thing based on the information you got. Here's my trick, right? What do you know? You only know what's in the income statement. You don't understand everything else that you might learn from some of the other financial statements. All right, so then you switch to the next page. All right, balance sheet. So let's take a look. Okay, so he's got cash on hand, right? All right, but he's got equipment. He's building up equipment. He's got some depreciation. I mean, he's got $569,000 in assets at the end of that same year. So not only did he make 300 plus K, he's got 570K in assets on hand. That looks pretty good, right? So it's not like, that's a problem. His debt is 208. So if we want to look at his debt versus his assets, he's got 569,000 in assets, and he's only got 208,000 in liabilities. Not so bad. Still want to invest? Still want to invest? Yes, still. Everybody good, right? All right. Oh, now you're wondering, so what's he doing here? It's like a trick. He's trying to mess me up. All right. So, but now I want to show you something here. At some point, you'll notice that he has a retained earnings. Now, this is a little tricky number, and I just kind of want you to understand. How many know what retained earnings is? I wouldn't expect you to know. I don't blame you for not knowing. But a retained earning number, if you ever see it on your own financials or any other set of paperwork you get from, I don't care, your financial company or whatever, the retained earnings is the collective total of all your earnings up to that point, your net income. So if you have a retained earnings number, this is true whether it's you've been in business for 80 years or eight years, okay? That retained earning number is derived at the end of the year when you take your net profit and it rolls into your retained earnings section, and it starts back at zero the next year on your income statement, but the rolling balance is in the retained earnings section, okay? So let's take a look. His retained earnings for the year's been $335,000. Okay, so now, man, that's good. That looks good. So now we've got solid retained earnings. We have solid assets versus liabilities. We have good consistent revenue. We have good consistent net income. Man, okay. So now you want to double your investment? You can double your investment. This is looking better and better by the day. Okay, all right. So here we go. Now we're going to shift to the one that I say never gets enough love, a cash flow statement. Let's take a little look. So a cash flow statement is the best way to figure out what's happening. It gives you the pulse of the company all in a snapshot. What's nice about a cash flow statement? It tells you every bit of money that comes in and every bit of money that goes out, whether it's for inventory, whether it is for regular expenses, whether it is seasonal, and you can project out a cash flow statement with the intention of seeing, okay, if I've got to gear up for a big July inventory push, I've got to spend money in March and April to make that happen. This is what your cash flow statement will tell you, okay? It will say, here, I got a property tax bill that I have to pay every January. I've got my insurance policy renews every 6 months, and I have to pay extra amount of money. You put all those things into your cash flow as a projection moving forward, okay, so that you can better address something that happens before you get surprised out of the blue and you look down and you have no money. We've all been there, right? You're getting down to the end of the month. Whoo, it's going pretty good. Next thing you know, you got to go to the dentist or you got to whatever, and you have to kind of, react. Well, in a business, you don't want to be scrambling if you can at all avoid it, right? Surprises happen. Going to happen. But you need to do your best to try to be prepared. So let's take a look at the cash flow, okay? Okay, y'all are going to know where I'm at here pretty quickly. Let's look at the cash, ending cash. The ending cash is the cash balance in the bank, okay? At $57,000 to start with, okay? The next month, it was a bit of a shortfall, $30,669. Then at $16,000, then $2,000. Okay, well good then. He kind of turned it back around. This is not uncommon. Start a new business. You might be negative cash flow for 6 months, 8 months, 9 months. That's not unusual, right? But you need to have the reserves on hand or the working capital on hand to overcome that. And then obviously you can't sustain long-term negative cash flow numbers, but it does happen, and it does happen sometimes very legitimately because you're going to make up for it somewhere else. This will tell you what's going on. Everybody put money into it. I had everybody put money into it. Let's take a little look. When the guy decided to open the second location, he's at $141,000 negative. He's coming back going, man, I need money. You think, oh my gosh, I put all this money into my whole life savings. What am I going to do? Okay, here's a little bit more. Help me get this thing straight. He comes back the next month. I'm $135,000 short. This guy's out of business, essentially. He couldn't make this work. Now, why did it happen? He had the profit. He had solid assets. He had decent liabilities. He had consistent work. What happened in his case? Can anybody guess, looking at this information? Marco's going to give a shot, which I'll let him just because. Well, growth is expensive. Yes, growth can be a tough thing to deal with because you're maybe spending money on equipment that you're only going to use for a few months when it's going to be the lifetime of it's many years old. Absolutely going to be a possible thing. What's another thing that can happen with out of the blue? We got growth here. He's not getting paid. He's billing these contracts. He's got these big government contracts. You ever heard about people fussing and complaining about, hey, Walmart makes me wait 120 days to get paid. So what happened to him? He paid lawyers. He paid, in his case, it was trucking. So he paid the driver. He paid for fuel. He paid for everything, 2, 3, 4 months. And then next month, he's doing it again. Next month, he is incurring every bit of the cost for a contract that got booked in January. He did not get paid for many more months after that. Absolutely can destroy, in this case, it destroyed a good business. He did not. Now, there might have been ways if he had came in earlier, where you could have helped him. Maybe you can sell your AR and take a hit, but still be profitable. In his case, he had to scramble around and do quite a bit to try to make this work. He did not shut down, but he had to complain. He had to change his model because he could not just keep holding out AR for 4 months, 3 months, 5 months, whatever, and still make this work. He either needed to charge more money, which still doesn't really answer your cash flow problem, but it does give you better margins. And maybe you can do that, maybe you can't. Or he needed, in his case, he figured out, he knew he was going to have to give up 2% to somebody who would buy the debt as long as the people his customers would eventually pay. In that case, it was a government agency and they were going to pay. They just took forever to do everything, okay? So, but if you didn't know that, you could have blown your whole savings and been shutting the doors down and not even be aware of what really maybe happened if you weren't keeping track of this. Now, if he only looked at the income statement, he'd be thinking things are rosy, lollipops and rainbows going on around here, right? And so that's why you want to have the financial information at your fingertips where you can answer, all right? Now, I'll give you another example. This one, the guy wasn't getting paid, but there's another very common problem with an industry that struggles right now, and that's retail. So, we had as example the cost of goods sold. They bought a bunch of inventory, right? And that inventory, what happens if it just sits on the table, sits on the shelf? You thought it was going to sell. I thought everybody's going to want this widget, and this widget isn't as interesting to other people as you thought it would be. So now you've got all this stuff there. So then, oh man, well I got to buy something else because I got to get some revenue. So you go buy some more inventory on top of that, and that old inventory sits there. So I'm gonna share. Would you go to the bank and make sure my time because I gotta. Okay. Yeah, good, okay. Would you go to the bank and say, all right, here's my deal. I got X amount of money in the bank. Give me a big fat stack of brand new $100 bills. Okay, they give you a big old nice stack of $100 bills. And then you take it to your new business that you've been killing yourself 60, 70, 80 hours a week to make happen and set it in the back shop on a shelf and go, whew, okay, glad I got that done today. Mark that off my things to do, okay? No one's ever gonna do that. But that's exactly what happens when people don't keep track of their inventory and stay on top of it. And not only that, I left those $100 bills sitting there I set them on the shelf and there's not even a lock on the door. There's no camera. There's no nothing. It's just like, I'll come back and, but where's some of my $100 bills? I have a stack this big. Now it's this big. Okay, I don't know. Well, there they go. You can't even do anything about it. So people often, I think, kind of run into the challenge of thinking of that the way that they need to. I mean, that is cash. Those are resources you have now cannot use. So you need to sell it, move it, flip it, whatever. Make decisions about what's happening because holding on to it, hoping that widget's going to be popular next year is not going to work. That's why the major retailers will keep it for so long, then they'll discount it, and then they'll do something, and then they'll just dump it off to Big Lots or Ollie's or whatever because they need to keep churning their inventory to be successful, all right? So the $100 bill problem is over there, and maybe it's not being taken care of. Maybe you don't have the security around it, all right? Maybe you're just sitting there watching it, but maybe someone throws something on top of the $100 bills, you forget it's even there. They come and put some big box of something else on it, and now you don't even realize I'll ask sometimes when I ask for a balance sheet, they'll give me a balance sheet, and they don't even, I'll ask, well, do you have a detail of, it says equipment, $27,622. It's all specific. So I'm thinking, okay, do you have a list of what that is? Well, no. I mean, it's this and it's a that and it's a whatever. Okay, so it's like, wow. I mean, there's, maybe it's there, maybe it's not. Maybe someone stole that generator or that welder and you don't even know it. And so now that's, and that needs to be reflecting, at some point you needed that to reflect in your financial statements. So in this particular case, I'm hoping I help you understand, cash is not the same as profit. Okay, that's what we're trying to make happen here. All right. So I'll zip forward a little bit. All right. We mentioned a lot of this in here. All right. So this is one of the mentions I didn't think about this, but vendor items, payables. Here's one of the challenges I see. It's kind of a red flag. People will book their revenue, and so their records, even if they're using QuickBooks or some other kind of accounting system, and they're pretty good about that, but then all the bills are sitting in a drawer, and then they'll just kind of pay them when they can. So they're not really in the system, and they don't understand how much they really owe. Well, I pay it. I sit down every month and I pay it. Well, what happens if there's more in there than you thought, and you get to it and you go, wow. So like, you really want to be diligent, like weekly or monthly at the absolute least, but weekly, you want to be sure to enter all your payables. And it's kind of weird to do sometimes because it's like you got to understand what's going on. You buy it on a credit card. Okay, so the bill in the credit card is due. Okay, that's different than the service connected to, the item. So you have an entry for the item itself, and you have an entry for the credit card. And so you want to make sure you're fully really reflecting what's going on. Because if you don't, you will be surprised. You'll hit, even if it wasn't an unusual event that made you be surprised, you will get surprised by something. I forgot all about the fact that I was going to pay the marketing people $5,000 this summer to do my holiday campaign. And now what do I do? Because you need that to be happening for you to be able to sell what you want in the holiday season. And now you're like, what do I got to do? And you scramble around, and there's always plenty of places to use cash, right? But that's one of the problems I see in books that when I'm looking at over people's books. Okay. All right. Let's see here. Now, overall bookkeeping. I only got a few minutes, but this is one of the things I wanted to, and some of these have kind of come up in our conversation. I gave you a breakdown. I want to say that is from a Profit Suit class, and I mentioned the Profit Lab. I did mention that, right? I just came from another class. Okay, well, make sure I didn't just say it in one place and not in my head. All right, so that is a nice little suggestion list they've got for bookkeeping hints, okay? And so most of these are going to be derived from there, but most of these really come from just things I see all the time. So I want to kind of just run through them a little bit. All right. Be consistent with your reconciliations and go ahead and reconcile, okay, everything every time, right? If you just get in the habit of routine and you don't let it pile up, it doesn't take that long to enter 5 or 6 or 8 bills. It could take, 2 hours to do it all at one time, but it'll be very helpful. I mentioned your management books are different than the books that you have for the accountant. And you got to be careful. I'm not saying don't go tell people hey, Chuck said at SBDC I got to have 2 sets of books, because they'll take that a whole wrong way. I'm not saying that, right? But you do need 2 sets of books, but they obviously need to sync up. It is interesting, the more you delve into some of what's happening, whether it's like a POS system or your inventory or whatever, what it will tell you. And most of the people you deal with aren't going to need that information. It's not going to matter to them, but it matters a ton to you, right? So understand that. And I would even say, we all are familiar with KPIs or key performance indicators, and maybe in a business or in a job, it's like, I need to talk to 100 people, or they need me to have a certain close rate on some, kind of conversation you have or whatever. But you can have your own KPIs or your own little report card about what is happening. And it can be in whatever you need. It doesn't have to necessarily match the KPIs the bank is going to look at. That's great, give the bank what they need. But maybe I had one guy who kept track of how many times he had a little catalog, a little pad, and he kept track of how many times the doorbell rang when they came in the door. Like, ding, So every person that came in, he kept tracking. He could see I had 122 people come in the store that day. And what he did is he started matching the number of people to other items in his financials, and he realized, no, not everybody's going to buy. Not everybody's going to buy a big ticket. Someone gets He didn't worry about all that. He just knew that if I could make sure I have X number of people, or at least this range of people, the rest of it's going to work itself out, right? Because he was aware of his cost of goods sold. He was aware of his margins. And so it can be something simple. That's my thing. Don't feel like it has to be some, high ratio, some professor at some university decided to make a living talking about, right? It can be whatever you need that's easy and you can manage. But I would say absolutely do that. And then, of course, we've talked a lot about the cost of goods sold. It needs to make sure it includes everything. This guy didn't include anything. Most people, even the ones that are trying their best, sometimes need to either take stuff out because they thought, like this cleaning supplies need to be there, or maybe they need to put it in. What is true in your case, like the guy with the machine. Most people don't include labor. He did because he needed to understand that. Completely justified. At the end of the day, an expense can be an expense, right? But you need it where you need it so that you can understand. All right? And then I'm going to say don't fall into the trap of a cash basis. An accountant, hey, they love to tell you, cash basis, IRS lets you do it. You don't owe any taxes. Okay, hallelujah. Let's do that for them. But don't just think that's going to work probably for you, right? In fact, QuickBooks and stuff, you can do it with the click of a few, buttons or whatever, right? But I would just say that, everyone pay the taxes that they have to pay, but don't pay any more than you got to pay, right? And our business is funded by taxpayer dollars, so I get it. But in the case, and I think just get yourself to understand how the accrual system works and that you're booking it out. And then next, after that, comes your cash flow. You've got to understand how that works out, all right? We did not get a chance to talk about this, and we are going to run out of time before I could really spend a lot. But I want you to write down this phrase. I want you to research it. I want you to look on YouTube. I want you, whatever you need to do, common size your financials. So I've talked you into, I hope, I've talked you into making sure you have all the financials, not just the income statement. We learned how that could be a problem. Not just your balance sheet, because it's only a snapshot. Doesn't tell you everything. I want you a cash flow statement, but common size. Common size is you take a percentage of the total. So in your income statement, the number is a percentage of the total revenue. And just learn, I could give you examples. It's late in the day. It's hot in here, right? Okay. But I want you to learn how to do that. Why? Because if you double or triple, those numbers mean nothing. It's all relative. It gets confusing. Well, am I spending more or am I spending less? Well, it all depends. I'm spending more on inventory, but I might be spending less percentage of revenue on my inventory than I ever have. But you don't know that. So what this does is if you common size your financials, you're just taking your information, you're playing a little trick with it, and it'll tell you what your percentages are. And it will help you see when now all of a sudden I'm spending 10% more on labor than I was all year. What happened? Or I'm spending 10% more on fuel, like the guy with the truck or whatever. So what happened? Well, it might be explainable. It may not. I tell you, it is the best way to find fraud and theft. Okay, well, it helps you in lots of ways. I don't want to make it about that only. It helps you in tons of ways, but it's the best way to figure out when you've had a significant or notable change in your information. Okay, so common size those financials and figure that out. If you take the Profit Soup class, you're gonna hear me say that 10 times a night for 6 nights. I hope you get it figured out. We'll use examples. We'll show and show you exactly how helpful it can be understanding what's going on there, right? So, and I bet none of you ever heard of that because I'm telling you, it's not real common. You'll often see a list of a financial statement, even if you get it from somebody, it'll have some percentages and, but they stick out the numbers. I'm telling you, the numbers they're great, whatever. They make you feel good if it hits $1 million or whatever, but really it doesn't matter. It's the percentages that you want to focus on. And the benchmarks that I can give you are going to be based on percentages too, okay? And then I would say stay current on all your taxes. You want somebody to shut you down faster than anybody else? Sales tax. slip up and forget to pay your sales tax, they'll come knock on your door and shut your door down. And it could just be a few $100s. Just you want to stay on top of it. And the tricky thing about sales tax is not an expense. It doesn't even show up. It shows up as a liability if you're doing it right. But a lot of people count it as expense when they pay it, and that's it. So their financials are all messed up. They don't even know what they owe. All right? So anyway, definitely address whether it's a property tax thing or it's a sales tax thing or it's an IRS deposit. You know, you got to keep them happy. And boy, you don't want to do everything you can to, you know, make a successful business and have something like that end up being the downfall, right? And then I suggest the separation of the principal and interest. I would definitely say over 95% of the people that post the payment in their books, if they even have books, they put it as one thing. And they'll even put a total. They might even be thinking they're doing okay, and they'll have it as a reduction in a loan and not have it as an expense, but it's still not right. It's all wrong. So, you know, that's just something I want, you know, once again, YouTube that, figure out what's going on there. Why does it matter, okay, that you do separate it? And I can promise you it matters to the bank or whoever might give you money if you ever need that. But more importantly, even if you're not trying to make them happy, it'll help you understand how profitable you are. All right? All right, anybody have any last questions as we kind of close out the day? Or, you know, I threw a bunch of stuff at you, right? I'm sorry. Use my card if you want to send me a message and say, hey, that class looks interesting. Or maybe you can just go sign up for the QuickBooks if that's something you're interested in. That's not the only time we'll do the class, but we don't always have a USDA grant to pay for it, you know, or anything like that. So be sure to kind of watch the list of classes as they come up. And I hope this, it's late in the day, it's hot, and it's financials and whatever, right? But if you now you think, man, I thought I knew I didn't really know exactly what I didn't know. Well, now maybe you have a few things answered, right? You know? All right, but is cash the same as profit? No, cash is not the same as profit. They have nothing to do with each other. Well, I mean, hopefully they have a little bit to do with each other, but they are, like evil people of each other or something. I don't know. One can fool you wrong, send you down the wrong path. All right, well, thank you guys. I appreciate it.